Either way, when it comes to managing a concentrated investment position, you have several options to consider. And so what's critical here is that if you decide to hold on to a large position for the long term, then it's essential to find a strategy that works for you and ultimately stay committed to that strategy for the long term. Making a generational impact starts with one person, one family, one community. And so the Gen 1 legacy is my attempt to help first-gen tech professionals like you get your financial house in order so you can live your legacy. All it takes is just one stock to go to the moon, and that's it. You're set for life, right? Well, if it were only that simple. You see, concentrated investing, or keeping all your eggs in one basket, seems to work until it doesn't. Now, make no mistake, concentrated investing isn't all that bad. In fact, notable investor Warren Buffett is known to have made lots of money decade after decade because he takes big bets. Even so, concentrated investing isn't for everyone. In fact, if you were to personally ask the Oracle of Omaha for investment advice, he'd likely tell you to buy a diversified basket of stocks that track the S&P 500 index and simply hold on to your investments for the long haul. And why would a sage investor give such seemingly conflicted advice? Well, that's because Buffett knows that concentrated investing cuts both ways. You see, on the one hand, you could score big under the right circumstances or find yourself desperately holding on to a failing position that wipes away your life savings when fate turns against you. Indeed, whether you've intentionally placed all your eggs in one basket or are simply trying to figure out what to do with your restricted stock or your stock options, then having a plan is essential to preventing unfavorable outcomes. And this approach begins with first checking whether you have concentrated holdings, then assessing your risk tolerance to manage such holdings, and then understanding how to rebalance away or hedge away risk when the time is right. So then, to the first point, how can you tell if you're holding onto a concentrated position in your portfolio or otherwise? Well, fortunately, there are several straightforward methods to figure this out. Now, the first approach involves evaluating your portfolio's asset allocation. And as you'll likely recall, your asset allocation refers to the mix of stocks and bonds, US and international holdings that you may have in your investment portfolio. Now, a portfolio heavily weighted towards a single investment or sector or industry is typically indicative of a concentrated position. For example, a general rule of thumb is that if you have more than 10 to 20% of your portfolio allocated to one stock or to one sector, then that's likely considered a concentrated investment position. Now, for you tech professionals out there, this sort of concentration typically happens when you have restricted stock units or RSUs that vest and you haven't decided what to do with your equity, so you just let it sit in your employer stock plan. It can also happen when you decide to exercise and hold your stock options, but don't have a strategy in place for your equity now that you own it. Now, another method for evaluating whether or not you have a concentrated investment position involves reviewing your exposure to a single asset or a sector relative to a benchmark index. And so what are we talking about here? Well, let's say that your portfolio has 30% invested in the tech sector while your equity benchmark index has 20% weighting in the sector itself. Now, in this situation, you'll likely find yourself with a concentrated position from the perspective of owning more of the sector than you otherwise would have compared to your benchmark. And finally, one last way to determine whether you have a concentrated investment position is by looking at your holdings from the perspective of a worst case scenario. For example, heading into the global financial crisis that took place well over a decade ago, many employees of the now defunct Wachovia Bank had their retirement savings stored up in company stock, which ultimately led to an unfortunate outcome for these individuals. That's because when the bank failed, the value of their holdings was effectively wiped out, and this canceled the retirement plans of many of the bank's employees and extending their working years. So then the moral of the story here is that if the failure of a single investment position would lead to a significant loss that could severely affect your financial plans, then you likely have a concentrated position. All right, so now that you understand what it means to have a concentrated investment holding, the big question now is, do you have what it takes to hold on to that concentrated position for the long haul? Now, this question is essential because, as you likely very well know, the road of investing is long and winding with pitfalls and windfalls alike. You know, it's like a journey where your risk appetite can significantly influence the trajectory and destination of your investment returns. And so what do we mean here by risk tolerance? Well, to be clear, risk tolerance refers to your ability and your willingness to bear losses in exchange for potential gains, especially when a large portion of your net worth is potentially ebbing and flowing with the whims of the markets. So then, for those of you out there considering or already maintaining concentrated positions, it's essential to have a deep understanding of not only those positions you're holding now, but also of how these investments are affected by market trends and narratives and principles alike. And why is that? Well, it's one thing to know everything about your company's stock, but to also understand what Mr. Market might think is also a powerful money management skill. Indeed, financial acumen paired with a disciplined approach is often what separates successful investors from those who experience significant losses. Indeed, for those of you out there who have studied market cycles or have simply lived through them, you likely already understand that downturns are inevitable and more often than not, unpredictable. And so now if you're a seasoned investor with a high tolerance for risk, then you likely will remain steadfast in your investment strategy during periods of heightened market volatility because you understand the broader economic and market factors at work and anticipate the longer-term investment play at hand. And yet, with all of that said, holding on to a concentrated position in market ups and downs isn't always as simple as understanding the technicals of market or economic factors. And why is that? Well, that's because investing can and often is an emotional journey. Indeed, when market volatility picks up and your net worth starts to swing to and fro, it can bring about a strong emotional response, like fear during downturns and euphoria during market rallies. So then within the context of an investment risk tolerance, your emotional fortitude is as crucial a trait to consider as all the other technical scenarios we just discussed. Indeed, in these situations, when market volatility picks up, you have to be able to resist reactive decision making and stick to your long-term investment plan no matter what's ahead of you. And this approach is especially true when a large portion of your wealth is tied up in your company's stock, and so you'll need to be able to hold on without panicking during periods of negative news releases or poor earnings performance. So then how can you tell if you're fit for holding concentrated investment positions? Well, the first thing that you want to do is evaluate your inclination towards maintaining your financial acumen in your given investment holding. More clearly, what you'll need to do is ask yourself whether or not you're well versed in the intricacies of the given sector or the market or the company financials of the investment you're holding, and whether you have the mental bandwidth and time to stay on top of all of the changes in these factors. Remember that more often than not, all it takes is one lousy report to send your investment plummeting, so you'll need to be able to stay on top of key developments and get ahead of those moves and make wise decisions. The next thing you'll want to do is assess whether you have the intestinal fortitude to deal with a single large holding and its potential impact on your wealth. More specifically, you'll need to determine whether you can endure periods of market turbulence without making rash decisions. For example, if you're tempted to sell investments or simply move to the sidelines entirely during periods of heightened market volatility, then managing a concentrated position may not be the right fit for you. And when it comes to evaluating your risk tolerance within the context of managing a concentrated investment holding, you'll also want to take a step back and consider your broader financial position. Now, more specifically, what you'll want to do is look beyond your investments and evaluate your entire balance sheet. Indeed, it's essential to take some time to ask yourself whether you have the ability to absorb potential losses when the market goes against you so that it doesn't impact your lifestyle or your financial goals. And so if you don't have the financial flexibility to weather a market downturn, then managing a concentrated position may not be the best fit for you. All right, so now that you understand what a concentrated position looks like and have evaluated your own risk tolerance, what else can you do if you have a concentrated investment risk that you just can't walk away from, but need to address in the present? Well, managing concentrated investment risk often requires a strategic, multifaceted approach that draws on a range of financial tools and principles to grow your wealth in a mindful way. Indeed, when it comes to managing a concentrated position, you'll need to consider several factors from complex things like tax consequences to finding the right trade-off between risk and reward to making prudent choices with your holdings. And so how do you go about managing these risks? Well, to start, let's come back to the first principles of diversification. Indeed, history has shown that over the long term, you can reduce the overall risk in an investment portfolio when you spread your money across multiple holdings. Indeed, by investing in a broad range of assets, you reduce the risk associated with poor performance of any single investment. And so how do you achieve this outcome? Well, that's where a solid asset allocation strategy comes into play. Remember, diversification is achieved by adding different asset classes like stocks and bonds to your portfolio, or by investing in different sectors or countries, or utilizing mutual funds or exchange-traded funds that offer instant diversification. Now, asset allocation, on the other hand, involves determining how much to allocate to these various investments, and more often than not, will be determined by your investment goals, your risk preferences, and your time horizon. All right, so with all that said, a common question that typically comes up with respect to diversifying concentrated position is whether you should sell all your holdings at once and just be done with it, or whether you should extend that selling over an extended period of time. Well, it's true that you could sell everything today, but there's a host of factors at play, including tax consequences and the potential for missing out on investment gains that you'll need to consider. And so depending on your situation, this is where portfolio rebalancing comes into play. Now, portfolio rebalancing is a proactive risk mitigation strategy that involves periodically buying or selling assets in your portfolio to maintain your desired asset allocation. And so in your situation, this could mean reducing a concentrated position by selling some of your investment holdings and then using the proceeds to to invest in other underrepresented sectors or asset types in your portfolio. So then by taking this approach, what you're doing is preventing your portfolio from becoming overly concentrated in a single investment while ensuring it aligns with your investment goals and risk tolerance. Okay, so now that you understand that to reduce concentration risk, you'll need to spread it out across various assets, the next question is over what time period? Well, if you have a long enough investment horizon, meaning that you don't need to tap into those proceeds from your concentrated position for quite some time, then you might be able to bear the short-term volatility associated with a concentrated position with the expectation of higher returns in the long run as you begin diversifying away this holding. Now, with all that said, if your investment horizon is short, meaning that you need to tap into that money sooner rather than later, whether that's for a home purchase or early retirement, then an extended diversification strategy may be too risky since you likely won't have sufficient time to recover from a potential market downturn when unexpected volatility hits. Now, outside of rebalancing as a way to mitigate the risk of a single investment holding, another way to deal with concentrated positions involves hedging. And what do we mean here? Well, hedging involves a rather deliberate process of making intricate investment decisions to transfer the risk of adverse price movements in a concentrated asset to a third party. Are you still with me? Well, here, let me put this process in more simple terms. What we're trying to do is reduce investment risk by using financial derivatives like options and futures to transfer risk or to hedge against a potential decline in the value of your concentrated position. Now, this concept can get pretty technical pretty quickly, so let me give you an example here to explain this a little bit better. Here, let's assume that you anticipate that the value of your company's stock is likely to decline in the months ahead for any number of reasons. So then in this situation, what you could do is enter into a contract to buy put options, which would give you the right, but not the obligation, to sell a portion of your concentrated stock at a locked-in price in the future. In a sense, it's like an insurance policy that if the value of your concentrated position falls significantly, you have some protections in place, but it comes with its own set of costs and trade-offs that you'll ultimately want to consider. Either way, when it comes to managing a concentrated investment position, you have several options to consider. And so what's critical here is that if you decide to hold on to a large position for the long term, then it's essential to find a strategy that works for you and ultimately stay committed to that strategy for the long term. Indeed, when it comes down to it, the road to successful investing, especially when it involves concentrated positions, requires a mix of self-awareness, emotional resilience, and strategic execution. Indeed, managing a concentrated position is like trying to balance on a high wire where the rewards may be as significant as the risks. Now, make no mistake, managing a concentrated investment position is often a full-time job, and is likely one reason why Warren Buffett encourages individual investors to simply buy a diversified basket of investments. Even so, the risks are far from impossible, so long as you're armed with the right tools and the right strategies, like knowing when you're concentrated and how to appreciate the risks and potential rewards of such positions. And here again, when it comes to successfully managing a concentrated holding, understanding your investment horizon, portfolio rebalancing, and hedging strategies can help guide you through the often turbulent seas of investing. Indeed, with these tools in hand, you'll not only be better equipped to navigate the often stressful but many times rewarding path of investing, you'll also be able to take one step closer to becoming the master of your own financial independence journey. To learn more about today's topic, you can visit the episodes page at legacygen1.com. And if you can find one person in your life who would benefit from today's message, please share this episode with them. But until next time, I'm Peter Donisanu, wishing you and yours abundant health and prosperity.
The Gen 1 Legacy Podcast is brought to you by Franklin Madison Private Wealth. Franklin Madison Private Wealth is a registered investment advisor firm with its registration and principal place of business in the Commonwealth of Pennsylvania. Registration of an investment advisor does not imply a certain level of skill or training. The information shared today is not intended to be personal, legal, investment, or tax advice, or solicitation to buy or sell any security or engage in a particular investment strategy. The commentary and forecasts are limited to the dissemination of and general information pertaining to Franklin Madison Private Wealth's investment advisory services and are based on economic and market conditions that are subject to change without notice. For additional information about Franklin Madison Private Wealth, including fees and services, please contact Franklin Madison Private Wealth or refer to the Investment Advisor Public Disclosures.